Hello and welcome to Owner's Equity, Treasury Stock, and Stock Options. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2020 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So this is talking about treasury stock. So what exactly is treasury stock? Treasury stock is when a company repurchases its own shares on the open market. Theoretically, this is really a way that they will call it giving back to the shareholders. It can give liquidity to the stock, and you can also drive up your earnings per share because when a company repurchases the stock, there are now fewer shares on the open market. But there are also downsides. During the whole COVID-19 with companies, they were really critical of those companies that have been using their cash to repurchase their own shares on the open market. There's also a lot of critique of this practice, meaning that, wait a second, why are you repurchasing shares when you could be using that money for dividends? And that would essentially drive up the tax revenue of various, of our government. So if you look at for treasury stock, and one of the examples that I tend to really kind of focus on, and Mr. Blank has not yet come after me yet, which I guess might be a good thing. I'll just pause this real quick and we'll take a look at Home Depot. So when we take a look at the owner's equity section of Home Depot, and this is probably the best one to look at in terms of treasury stock. So we have three different things we're concerned with. We've got authorized, issued, and outstanding. Authorized is the total amount a company can issue. Issued means how many did the company actually distribute at one point in time. But outstanding is the issued less whatever the company has repurchased. So when we look at this here, of Home Depot shares, they've got 1.7 billion shares issued, but outstanding they only have 1,077 million shares. Why is that difference? That difference is coming from this, or treasury stock. What is extremely fascinating about Home Depot is that when you look at them, the assets here are a total of 51 billion. Their liabilities are 54 billion. You would say, oh my goodness, are they insolvent? But the reality of it is that they have repurchased so much of their own shares. Right over here, they have $51 billion of net income that they have not distributed to their shareholders, but they have repurchased $65 billion of their shares. And so that's a huge, huge dollar amount. And if we look at what's that kind of has done in terms of their earnings per share, their earnings per share are for the year ended, basically for the year ended December 31st, 2020, or their fiscal year is really there as of February 2nd, 2020. They call it a fiscal year just because with the Christmas season, most retailers will use a January 31st or early February. But here, Home Depot is having a basic earnings per share of $10.29. And a big reason for that is because of how much they've gone through and purchased. This is based on the outstanding shares. That's how they compute earnings per share. So treasury stock, again, this is how it impacts. A company is deciding to go back and to repurchase their own shares. That's what treasury stock is. What's also really important about treasury stock is that when I repurchase my own shares, I do not call that an asset, because if you think about it, when I'm buying back my shares, I'm crediting cash, and then I'm debiting what we call treasury stock. I'm returning shares back to the treasury. So when you are looking at this from a perspective of, in terms of how we go through and are recording this, we don't call treasury stock an asset. What it does, it's going to reduce owner's equity. As we just saw over here, when I repurchase my own shares, this shows up as a negative in my owner's equity account, right? Because it's essentially reducing my owner's equity. So this is how we go through and treat treasury stock. When I was first starting in public accounting, I worked at Coopers & Lybrand, now PricewaterhouseCoopers. One of my clients that I was working on was the Mirage Golden Nugget when Steve Wynn owned it. To finance Treasure Island, what they did is that they had repurchased shares when I think they might have been around $5. So for Golden Nugget, they bought it for $5 and they turned around and they resold it at a profit. They thought that their stock was too low. So they basically went out and they repurchased their own shares on the open market. So, and then they repurchased shares, and then they went out and then they sold them again when the stock got a little bit hotter. So it can be a way for companies to, if they want to show that they believe in the stock, that's a great thing. But again, this is a very controversial issue just because so many companies have been buying back their own shares. But now let's go through here and take a look in terms of how do we do the accounting for treasury stock. So let's take a look at an example. So we've got Topet Inc. Repurchased 400,000 shares of its own common stock on the open market for $10 per share on June 30th, 2018. How do we go through and record the entry for the treasury stock? Okay, well, on June 30th, 2018, I'm going to be debiting treasury stock. The amount I'm going to be debiting treasury stock for is going to be 400,000 times $10 per share, or $4 million. And then I'm going to be crediting cash. And this is going to be here. We are going to be calling this to record purchase of treasury stock. So again, when I'm buying treasury stock, I'm taking the number of shares. Basically, this is 400,000 times $10 per share, or $4 million. And that's pretty much it. So that's how I go through and basically record that treasury stock that first part of my transaction. The second thing is what happens, well, this is when you buy it, but what happens when you go through and you sell it? So when we sell our treasury stock, the important thing to remember is we're never going to be recording gains because we're really dealing with our own shares. With losses, we're not going to be recording losses, but if we do have what we would call a loss, then we would be going through and hitting up retained earnings, but we'll see how this works. So over here, my first date over here is, my next date here is going to be, I'm selling on September 30th, 2019. I'm selling 25,000 shares, what I purchased up here, for $40 per share. So here I'm receiving cash because I'm selling. So I'm selling 25,000 shares that I had purchased up here. So right over here, I'm going to be crediting cash over here for 25, debiting cash because I'm receiving cash after selling them. This is going to be 25,000 shares at $40 per share. Okay. So now this is where it gets kind of fun. So I'm debiting cash. What do I credit? So I sold 25,000 of these shares for $40 per share. So this 40,000, this is basically $40 per share times 25,000. 40 times 25,000 is $1 million. That's where we're getting our cash. For every debit, I need a credit. So I'm going to be crediting treasury stock what my cost was. My cost for these 25,000 shares was $10 per share. So I'm going to be crediting treasury stock over here of 25,000 times 10 or 250,000. Now, what's interesting is you might say, hey, I made some money on selling my own stock. However, if we are dealing with our own stock and we start recording gains, that sounds like we're going to go to the federal prison, and we don't want to do that. So instead, what we're going to be doing is additional paid-in capital, treasury stock, and we're going to be reporting this here for the difference, or 750,000. And so as we're going through and doing this, right, and this is basically to record resale of treasury stock. Okay, so I've gone through here, everything's great. I've sold some stock at a profit. Let's go over here to the next one. Okay, so here I'm selling 100,000 treasury shares that I purchased on June 30th for $1 per share on November 15th. Okay, so over here, I am debiting cash. I'm going to debit cash for 100,000 treasury shares, my shares of stock, times $1 per share. Or over here, so I'm going to get a total of $100,000. So the next thing I'm going to need to do is I'm going to need to credit treasury stock for what I originally had paid for the shares. So what I originally paid for these shares is I paid $10 for them. So similar to this part right up here, I'm going to be, so the cash is 100,000 shares times $1 per share. So for my treasury stock, this is going to be 100,000 treasury shares times the $10 cost per share. So this is going to be, well, everybody, I've been interrupted by a kitten. So hello, we have a kitten interruption. Sorry, I had to break up this meeting. Very, very important though. Kitten interruption. I'm not sure if this is a kitten or if this is, if I could call myself Joe Exotic of the Tiger King. I'm not really sure, but I needed to stop the video for this moment. This is Gray. Gray, want to say hello to everybody? Right, half of Ozzy and Gray. So we'll see Gray a little bit later. So hi, we're back after that kitten break. So we sold 100,000 treasury shares for $1 per share on November 15th, 2019. So I got $100,000 in cash. I need to credit treasury stock for what I actually paid for the shares. So for these shares right over here, I paid basically 100,000 treasury shares. My original cost was $10 per share, or a total of $1 million. So right over here. So that's my $1 million. Now, what I need to figure out though is that what are my balancing entries going to be? Well, the first thing is I need to see, do I have any previous amounts that I recorded as additional paid-in capital treasury stock? And the answer is yes. On September 30th, I had a gain, but I can't call it a gain. So I credited additional paid-in capital treasury stock. So what I'm going to do here first is I'm going to credit treasury stock for $750,000. One of the reasons, and if you see some of I've kind of been remaking some of these videos because I made an error when I was going through and doing this. My general rule is right here is that my additional paid in capital treasury stock can never have a debit balance. So over here, so I had 750,000 over here on September 30th. And so I want to take this amount down to 0. So over here, I'm going to be putting this here at debiting this for 750. And this would be on 11/15. This account now has a 0 balance. I can never run a debit balance in additional paid in capital treasury stock. So normally what we would call this would be a loss. However, in this case right over here, we can't call it a loss because we're dealing with our own stock. So what I'm going to be doing here is I'm going to be debiting retained earnings. And this over here is going to be a balancing entry of 150,000. And it's really whatever I need to do here to have my total debits equal my total credits. So over here, I've got total debits of $1 million, total credits of $1 million, so I'm good to go. But again, what's really important to remember is that when we're dealing with treasury stock, we don't call it, if we're selling it for more than what we paid for it, we don't call it a gain. We're just going to credit additional paid in capital treasury stock. However, if we lose money on our treasury stock, first thing we do, we take any existing credit to additional paid in capital treasury stock down to 0, which is what we just did here. The balancing entry is going to be going to retained earnings. So the last item I want to share with you is about stock options. I'm not going to be doing the journal entries to do this, but it's just important that I want you to understand is that stock options can really distort a company's position. What exactly is a stock option? A stock option is essentially a way to incentivize, retain, and recruit employees. And so right over here, they need to be priced on the date of the grant. You cannot backdate stock options. What exactly is a stock option? If I want to incentivize somebody to come to my company, I can incentivize them with ownership. So there's a whole way in terms of going through and how to recognize the stock compensation expense. But when I go through and I record stock options, the general journal entry that you're going to be making is you're going to be debiting compensation expense, and I'm going to be crediting additional paid in capital common stock. Now, there's no liability for a stock option. So generally what happens here is that you've got a credit to common stock. You have a debit to compensation expense. Where is this going to get closed out to? Well, compensation expense is going to be closed out to my retained earnings. So what ends up happening is that this becomes ultimately a wash in owner's equity. It kind of seems to overstate additional paid in capital, but it also lowers the amount of our retained earnings. When you look at a company over here, and this is Twitter, back here, during their, I believe it may have been their 9 months ended September 30th, 2017, they had a loss of $199 million. However, what's really interesting about this is was that truly a loss? And the answer is no, because what this loss was really created was as a result of their stock compensation expense. So it's one of those things that just to kind of be aware of is that, how does that journal entry work? Well, it's going to be a debit to compensation expense and a credit to additional paid in capital common stock. But I think I've always had a problem with this because to me, additional paid in capital common stock should really just be used when we're going through and we're selling shares. So that's pretty much, thank you for watching. Please do not forget to like and subscribe. And if you have any comments or questions, please feel free to send them to me at 1812cpa@gmail.com. Have a great one and have a pleasant tomorrow. See you soon.